Welcome to today's Explainer. We're going to be peeling back the layers of Kinder Morgan's massive second quarter 2026 earnings report today. Now, if you follow energy infrastructure at all, you already know these dense reports are just packed with microscopic data. But today, we're really going to decode those numbers to map out the real so what behind one of North America's absolute largest energy engines. So let's just jump right in. $867 million. Let that sink in for a second. That is Kinder Morgan's all-time record-high second quarter net income. And just to put that sheer scale into perspective, that's a massive 21% jump from the exact same quarter last year in 2025. I mean, when a company of this immense size, we're talking tens of thousands of miles of pipelines, moves the needle by 21% in a single year, you know something fundamental is shifting in the macro environment. And honestly, this just sets the perfect stage for everything else we're going to look at today. Okay, let's dive into this because the sheer scale of this profit is staggering. But headline numbers like this, they don't just happen by accident. They're the result of a meticulously constructed foundation. You know, it's really easy to look at a soaring energy company and just assume, oh, they just got lucky with a spike in commodity prices. But that fundamentally misunderstands how Kinder Morgan actually operates. Now, this quote from Executive Chairman Richard D. Kinder is absolutely the key to understanding this entire explainer. Notice the specific phrasing he uses here: fee-based business model and predictable cash flows. Kinder Morgan has essentially built this massive continental toll road system for energy. Think of it like the ultimate continental easy pass. They aren't out there wildly betting on the day-to-day price swings of natural gas or oil. Instead, they're just charging a toll to move it from point A to point B. And by locking in these long-term contracts with financially rock-solid customers, they totally insulate themselves from all that market chaos. Whether the energy market is booming or panicking, the toll still gets paid. And really, that is the bedrock of this record quarter. And this brilliantly illustrates exactly how powerful that toll road model is in practice. We're looking at their adjusted EBITDA jumping from roughly $1.97 billion in Q2 of 2025 all the way up to nearly $2.2 billion in Q2 of 2026. That is a solid 12% jump. Furthermore, CEO Kim Dang also highlighted that their adjusted earnings per share, which is the direct value actually delivered to shareholders, shot up an astonishing 32% to 37 cents. When your core cash-generating metric and your earnings per share are both growing by double digits, your engine is running perfectly. But it does make you wonder, what exactly is fueling it? Well, the answer is the natural gas demand boom. This is the macroeconomic engine that is driving these historic numbers. The report outlines three soaring demand pillars right now: increasing LNG exports, rising power demand, and massive industrial expansion. When you have these three massive forces pulling simultaneously, every single inch of existing infrastructure becomes incredibly valuable. I mean, you can't just snap your fingers and build a brand new pipeline overnight, right? So the pipes that are already in the ground become absolute gold mines. They're highly utilized and immensely profitable. Let's actually break down how that demand looks out in the real world. KMI President Dax Sanders reported that natural gas transport volumes were up 7%, and gathering volumes were up an incredible 26%. Now, that gathering growth was heavily driven by their Kinderhawk system. But look at the transport side for a second, because this is where it really hits home. That 7% bump wasn't just some speculative trading, it was driven by the very real-world need to feed LNG facilities, export energy down to Mexico, and, remarkably, to keep the lights on in Arizona due to higher power generation demand on the El Paso natural gas pipeline. This is real energy meeting real human needs. So the crucial point here is that while natural gas is undeniably the star of the show, this record quarter was really a team effort. This quick survey of their business segments completely proves the growth wasn't just isolated to one area. Products pipelines pulled their weight, going up from $289 to $339 million. Terminals saw a really solid bump thanks to higher rates and fees over at their Houston Ship Channel hub. And interestingly, look at the CO2 segment right down at the bottom, jumping from $145 to $207 million, which was driven by a 15% volume increase at their massive Sackrock field. It's a completely diversified beat across the board. Which brings us to this absolutely beautiful number: $1 billion in free cash flow just for the second quarter. Now, for a giant infrastructure company, having a billion-dollar cash engine means they can internally fund their next phase of growth. They don't have to go out and beg the banks for high-interest loans. They can literally build the future using the cash they're generating today. Now, what's really interesting about this is the allocation in their $9.6 billion project backlog. Remember,
Kinder Morgan is a highly diversified energy company, yet an overwhelming 92% of their future bets are placed squarely on natural gas projects. That is a massive, highly convicted strategic pivot toward natural gas being the dominant energy carrier for the coming decades.
And this isn't just abstract finance we're talking about. Over 60% of that massive natural gas backlog is directly associated with supporting power generation and local distribution companies. What you really should take away from this is how closely it ties into your everyday life. This backlog is literally funding the infrastructure that ensures your local power grid doesn't just collapse during a summer heat wave, and that your home has reliable heating during a winter freeze. They are physically building the backbone of the modern economy. So, how does this massive backlog actually map out in the real world over the next couple of years? Well, from terminal expansions in early 2027, moving all the way through to massive pipeline projects like SSE4 in late 2028. And the company expects these remaining backlog projects to generate an aggregate first full-year project EBITDA multiple of approximately 5.6 times. Simply put, that means for every dollar they spend, the return profile is highly attractive and heavily visible for years to come. I actually want to zero in on one specific project from that timeline because it reveals a really surprising modern twist. Notice the Amarillo expansion project out in the Texas Panhandle. Why exactly are they building this? Well, the report explicitly states it's being developed to support growing demand, including additional data center development. I mean, that is incredible. This pipeline isn't just for traditional heavy industry anymore. It is explicitly being built for the cloud. The explosive growth of AI and data centers requires massive, stable, baseload electricity, and Kinder Morgan is putting the physical pipes in the ground today to feed the digital economy of tomorrow. And because this second quarter was so extraordinarily strong, it has fundamentally shifted the company's entire 2026 financial trajectory upward. Coming into 2026, they had budgeted $8.6 billion in adjusted EBITDA and $1.36 in adjusted EPS. But based on everything we've just unpacked today, they've completely rewritten that new reality. They now expect to end the year more than 5% favorable to budget on EBITDA and a massive 12% favorable on adjusted EPS. A single record-breaking quarter literally just pulled the whole year's outlook up with it. And remarkably, they're doing all of this while remaining incredibly disciplined. 3.6 times is their net debt to adjusted EBITDA ratio at the end of the quarter. That sits super comfortably right at the low end of their targeted range, and they actually expect it to end the year exactly there. This metric proves that while they are growing aggressively, bringing major projects online and really leaning into this data center demand, they are doing it safely. They absolutely are not over-leveraging the company just to chase this growth. Which leaves us with this final thought. We've seen the record cash flow, the major pivot to natural gas, and that incredible toll road model totally insulating them from market chaos. But look at the horizon. As the world demands exponentially more power for things like AI and advanced data centers, and as regulatory hurdles frankly make building new infrastructure harder than ever before, we really have to ask, just how critical will Kinder Morgan's existing network of pipes and terminals become? If the second quarter of 2026 is any indication at all, the value of having those pipes already in the ground is completely irreplaceable. Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll see you next time.